In Chapter 3, we are going to be looking at the next phase of our accounting cycle, which is called adjusting accounts for financial statements. So these are our learning objectives. We're going to explain the importance of periodic reporting and this thing, accrual accounting. We're going to look at the procedural parts, preparing special journal entries we call adjusting journal entries, and how we update our general ledger for these adjusting journal entries so that we can create an adjusted trial balance, which is what we use to prepare financial statements. So, first of all, why do we have to report information every so often, monthly, quarterly, or yearly? Well, and there's our accounting time. An accounting cycle lasts 1 year. Okay, so we could wait a whole year and create a financial statement, or we can create a financial statement every 6 months, or monthly, or every 3 months. It depends on the company, but you have to do it at least once a year. Accrual basis, the accounting we're doing in here, says revenues should be recorded when products or services are delivered. So when you do something for the customer, whether it be give them a service or a product, you should record revenue. And you record expenses when they occur, not when you pay them, when they occur. Cash basis accounting is a little different, and we don't use cash basis accounting in this course. But in cash basis, revenue isn't recorded until you receive the cash from the customer, and expenses are not recorded until you actually pay them. Now, there's reasons why we use accrual over cash. And your author likes to talk about them a little bit, but I'm not going to get into them. I want to focus on accrual. So I'm just going to you could read through these, but I'm going to focus on this, our revenue recognition. That is one of our principles from Chapter 1, and it comes back to us here in Chapter 3, and actually we were using it in Chapter 2. The revenue recognition principle says revenue is recorded when goods or services are provided to that customer, and we record them at the amount we expect to receive from the customer. Recognizing expenses, we use the expense recognition or matching principle, and that says expenses should be recorded in the same accounting period as the revenue that caused it. And if you can't match the expense up with the revenue, then record the expense in the accounting period it occurs. So, you have to keep those two rules in mind as we're talking about this chapter, because they really do explain why we're about to do what we're going to do, if that makes sense. But so far in our accounting cycle in Chapter 2, you recorded transactions as journal entries, posted the journal entries to the general ledger accounts, and when you're getting ready to make a financial statement, you create your first trial balance, which is called an unadjusted trial balance. And that's what we're now going to call that trial balance you did at the end of Chapter 2. We now go into Chapter 3, which is a continuation of this 1 year accounting cycle. And that says, oh wait, you're getting ready to do a financial statement? Hey, let's make sure all of the revenues that have been earned and all the expenses that have occurred are recorded. We haven't done that step yet. And if we find any revenues missing or any expenses missing, we need to make more journal entries and get them recorded in the accounts in the general ledger. And that's why we have this thing called adjusting entries. Adjusting entries are really the result of finding missing revenues and expenses and creating journal entries for them. Now they call them adjustments, okay? And you can see the common ones. The first one's called deferral of expense. deferral of revenue, accrued expense, and accrued revenue. Now, adjustments are usually made using a three-step process. We determine what the current account balance equals. We then determine what should it equal, and then make an adjusting journal entry to get from step 1 to step 2. Now watch. So let's take a look at the first type, deferral of expenses. What is that? Well, if you remember in chapter 2, you paid for insurance for future coverage. And insurance is a common expense that you pay for it before it occurs. In the accounting world, we call that either a prepaid expense or deferred expense. The key is when you made that payment, you debited an asset, usually prepaid expense, and credited cash. The same thing could happen with rent. You could prepay it. And supplies are also considered a prepaid expense. During the adjusting process, we try to figure out, did we use up any of that asset? Should we call any of that an expense now? It really is an expense, but the day we paid for it, we couldn't call it that because it didn't happen yet. But has any of it happened by the time we're getting ready to do our financial statement? And if it did, what do? And you could see what we do right there. We're going to end up moving the part that did become an expense into the expense T account by debiting it and decreasing the asset by crediting it. Let's take a look. Here's an example. Fast Forward paid $2,400 to cover insurance for 24 months that began on December 1st, 2019. So the day they paid that, December 1st, they didn't debit insurance expense. They didn't receive any coverage yet. None of the insurance has expired or the insurance coverage period didn't even start yet. So on December 1st, they debited an asset account called prepaid insurance to show that insurance coverage was owed to them. And then they credited the cash account because they paid for it. But by December 31st, the question comes, did any of that insurance go away? Did any of it expire? Did we use any of that policy up? And the answer is yes, 1 month's worth. So at the end of 2019, December 31st, the balance in prepaid insurance shouldn't be $2,400 anymore. It should be $2,300 because we've used up $100 of the premium coverage because we received 1 month of the 24 months coverage. So we'll debit insurance expense. Now that part of our prepayment can be called an expense and reduce prepaid insurance by crediting it. So when we update the accounts, now there was a missing expense. $100 of insurance expense was missing. And our asset is properly being reported at the end of the time period that we're getting ready to do our financial statement at the $2,300 balance. And there is the journal entry itself that would be made in your journal, just like you make it with all your other journal entries. The same thing occurs with supplies. That's considered a prepaid expense. So the company purchased $97.20 of supplies in December. Every time somebody goes in the supply closet and comes out with a pencil, they're not running into accounting going, guys, took a pencil. No, we're not paying attention to that. But at the end of the time period we're looking at, that's when we start paying attention to what's in the supply closet. So we'll go in and take an inventory and determine the value of the supplies still on hand. And that's what they're doing in step 2. At December 31st, there's $8,670 of supplies at the end. So the amount that was in there, $97.20. The amount in the account. The amount actually in the closet, $86.70. So the difference was used up or has become an expense. So supplies expense is debited for the $1,050, the amount of supplies used up during the month. Supplies account needs to be credited. If you didn't credit the supplies account, it would look like you still had $9,720 of supplies. You don't. And that's what the journal entry and the posting to the T accounts would look like in the general ledger. So you make your journal entry in the journal with all the other journal entries. So these are your two common examples of prepaid expenses. The part that expires must be and becomes an expense must be recorded by the end of the period you're looking at. Another expense is depreciation. Now, a lot of us go, oh, depreciation. I know what that is. It's when something goes down in value. Yes, that's the real world definition of depreciation. But our definition is something else. When we buy a plant asset, something like equipment, buildings, cars, these are assets that you can see, you could touch, they're tangible, and you're going to use them in your business for more than a year. So those kind of assets we call plant assets. Instead of when we buy them, expensing them and saying, whoo, bought that thing, used it up. No, we call it an asset. It's something we own. But we will use that asset up, but over more than 1 year. So instead of expensing the purchase the day we buy it, we expense what we paid for that asset over the time we think we're going to use it. And that is what depreciation is in accounting. Now, we have different formulas to determine the amount that we should expense, and it's all formula driven. The most common way is called straight line depreciation. The formula is take the cost of the asset minus the salvage value, and salvage value is what you think you could sell it for at the end. So the company estimates for that, and that's okay. And we divide that difference by the useful life. How long does the company expect to use it? Well, that much of that asset should be expensed each year. So please make sure you understand what the definition of depreciation is in accounting. Now, the useful life again is how long the company thinks they're going to use it, and it has to be rational. Salvage value, sometimes called scrap or residual value, is how much they think they could sell it for at the end. So let's say fast forward purchased equipment on December 1st for $26,000. They expect to use it for 5 years, and it's going to be worth $8,000 at the end of 5 years. So that's all prediction. It's December 31st now, so the question is, do we have to expense any of that? And the answer is yes. We will fill in our formula. 26,000 cost minus salvage value. So the amount that we will calculate depreciation on is the difference between those two, 18,000. 18,000 is then divided by 60 months. Since only 1 month has occurred from the date they bought this equipment to December 31st, we want to know the month amount of depreciation. 5 years is 60 months. So we must expense, so we will debit an account called depreciation expense. So we'll increase that for the $300 we just calculated. We do not credit the equipment account. Instead, we use an account next to it that we credit called accumulated depreciation. Now, what is accumulated depreciation? It's a special type of account. It's an asset, but it's a contra asset. Contra assets, or any contra account, usually increases, it always has a buddy. It always must have another account it goes with. It always increases on the opposite side of its buddy. And it's storing information about its buddy. So instead of crediting the equipment account directly, we credit accumulated depreciation. And now that's keeping information about the equipment. What is the information? That's how much depreciation has been recorded on the equipment. So there's your journal entry. Debit depreciation expense, which is an expense account. That's how much of the cost of the equipment we actually are going to expense based on our formula. Credit the contra asset, accumulated depreciation, and they have equipment. And you'll see how this all jives together in a little bit. And there it is. When you report your equipment on the balance sheet, remember equipment is an asset and it gets reported on the balance sheet. You just don't write $26,000 anymore. No. You take the cost of the equipment, which is the balance of the equipment account, $26,000, and subtract the balance in the contra asset, accumulated depreciation. Now this is the balance sheet as of February 28th, 2020. So there would have been depreciation expense recorded for December. We saw that 300, all of January, and all of February. So by the end of February, there's a $900 balance in the accumulated depreciation account. Subtract that from your equipment and report the net, or what we call the book value, on the balance sheet. Excuse me. So you'll keep increasing that accumulated, increasing it, and increasing it over the life of the asset, because you're going to be expensing more and more and more of the asset as you use it up. Now, more adjusting journal entries for deferral of revenue. So we saw deferral of expenses. That's when you pay for an expense before it occurs. You debit an asset account, prepaid insurance, supplies, and then as you use up the asset over time, you credit the asset, debit the expense. Depreciation. When you purchase a plant asset, it is put into an asset account. It is debited to an asset account. But you will expense what you paid for that asset over the time you will use it. Debit depreciation expense, credit accumulated depreciation. The next journal entry, deferral of revenues. Sometimes customers pay us early before we do anything for them. On the day they pay us, we can't call that payment revenue. We haven't done anything. So what do we call it? Unearned or deferred revenue. This is cash received in advance of providing products or service. So the day you get the cash, you owe the product or the service. So unearned revenue or deferred revenue, whichever term you use to describe it, is a liability. And the liability will increase the day you receive the cash early. Well, over time, you will start providing that service to that customer. As you provide service, you'll increase the revenue because you've earned it and decrease the liability because you no longer owe it. Take a look. Fast Forward's clients paid 60-day fee in advance, covering the period from 12/27 to 2/24. So on December 26th, the company received $3,000 cash. So this isn't the adjusting journal entry. This is just what happened on December 26th. On that day, they debited cash to increase the cash, and then they increased the liability, unearned consulting revenue. Now, Fast Forward in step 2 earns payment as time passes. So what that means is they can call a part of that revenue each day. They don't do that until they're getting ready to do a financial statement. So it's December 31st. 5 days of the 60-day service has been earned. So 5/60th, 60-day fee, remember, 5/60th of the $3,000 can now be called revenue. So we're going to create a journal entry to reduce the revenue, or I'm sorry, to increase the revenue and reduce unearned consulting revenue, which is the liability. This is what will result. So now we'll credit consulting revenue. Add that in there. It's missing. It's been earned by the end of the year. Decrease the liability unearned consulting revenue because that part of the $3,000 is no longer owed to the customer. There's the journal entry itself. That will go in your journal with all your other journal entries. They didn't give you the T accounts in that one like they did on the deferred expenses. 2 more to go. So 3 of the 5 typical adjusting journal entries. Let's take a look at the next one. Accrued expenses. First of all, an accrued expense is an expense that's incurred. It happened. It's not paid yet and it hasn't been recorded yet. You just don't go, oh darn, we didn't get a bill. Guess we didn't have an expense. No. If you know you received a service from someone, whether you get a bill or not, you have an expense in that accounting period. So you have to increase an expense. And normally, if you're doing that kind of work, you didn't pay it yet. So remember, an accrued expense is both unpaid and unrecorded. So you've got to get it recorded as an expense. And since it hasn't been paid yet, the opposite side of the journal entry will be increasing a liability. Look, Fast Forward pays its employees $70 per day or $350 for a 5-day work week. Salaries are paid every 2 weeks on a Friday. December 31st is a Wednesday, so 3 days' salaries are owed at year end. So what this is saying is, it doesn't matter when we pay our employees. What matters is, when did they do the work? And it's the time period that they do the work that we call it an expense. Most of the time, when we pay our employees, the time they worked and the day we pay them fall in the same accounting period. But that's not what's happening here. So, on December 31st, we really owe our employees $210. Now, we don't write them out a check. Okay, payday's payday. But we do have to record that there's 3 days of salary expense not recorded yet. So the accrued expense will be debit salaries expense for the $210, credit the liability salaries payable to show the company owes that. And so now you can see salaries expense is at the proper amount for the proper amount of activity the employees did for the month of December. And liability is properly reflecting that the company owes $210 to the employee. Now, what happens in January when this employee gets their paycheck? Now, this isn't adjusting entries. This is just showing you what happens when this employee will receive their money. So on 1/9 of the next year, they receive their $700 for their 10 days of work, 2 weeks. So cash is credited for $700, 70 times 10 days. The first 3 days has already been recognized as an expense last year and is currently waiting to be paid as a liability. So salaries payable will be debited. They're paying that now. The remaining 7 days are recognized as an expense because they occurred in this current financial period after the financial statement was completed. And that is not to record earned revenue received in advance. That is a bad explanation. That's to record payment to employee in the next year. The last adjusting entry is for accrued revenues. So when you have accrued expenses, you will also have accrued revenues. An accrued revenue is a revenue that's been earned. It's been earned already, but it hasn't been recorded and we haven't received any cash yet. In this case, you will have to increase a revenue. You have to. You earned it. You didn't get the money yet, so it's owed to you, so you're going to be increasing an asset as well. Take a look. December 12th, Fast Forward's customer agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. Great. On December 31st, 20 days worth of services have been provided and earned, which totals $1,800. Now they're not paying till next year, and we've already completed $1,800 of services, 20 of the 30 days. We just don't go, oh, well, we didn't bill them. I guess we don't record revenue. No. Did we earn that revenue? Yes, we did. Then you must credit your revenue account, consulting revenue, and debit accounts receivable. As of December 31st, you've earned that revenue. Nobody's paid you any money yet, and you haven't even recorded it. So debit accounts receivable to show that is owed to the company. Now we have a good balance in accounts receivable. There's the debit. And our revenue is increased because it should be. We've earned that extra $1,800. Now, what happens next year when we actually get the money? So this is fast forwarding. This is not an adjusting entry. It's just showing you, kind of bringing this transaction full circle. What happens when we get the money? Well, now it's January 10th. We debit cash because the company's paying us $2,700 in cash. The first 20 days of revenue associated with this cash has already been recorded last year, and it was stored in accounts receivable waiting for the customer to pay. So we're going to credit accounts receivable for $1,800 of it. The other $900 that was earned from January 1 through January 10th is consulting revenue. That part can be called revenue because it was earned during January. Wow, that's crazy. Okay. Deferrals. So depreciation is kind of linked into deferrals. These are amounts you paid or received cash before the expense or revenue is recognized. Remember, like prepaid expenses, prepaid insurance or supplies, you're going to be debiting an expense and crediting an asset when you make the adjusting entry. So if you never made this adjusting entry, you wouldn't have recorded enough in expenses and your assets would be at too high of a value. So they're just showing us what it's like before. Deferral of revenue. That's when we receive money before we've completed the transaction. When we complete the transaction, though, as we complete it, the adjusting entry will be a decrease to the liability and an increase to our revenue. So if we never made the adjusting entry, our liabilities would be too much and our revenues would not be enough. Accrued expenses. The expenses occurred, it isn't recorded yet. We want to increase our expense and increase our liability. Both would be understated if we never made that journal entry. And accrued revenue, same thing. If it's revenue that's been earned but has not been recorded yet, it needs to get recorded. If it was earned this accounting year, it's recorded now. So we debit accounts receivable asset, credit revenue. If we did not do that, both assets and revenues would not have enough in them. So you could see what this adjusting process does. It's rooted in the revenue recognition and expense recognition principle from the beginning of the chapter. Record revenues when they're earned, record expenses when they occur. During the adjusting journal entry process, we are looking for missing revenues and missing expenses. And those items are usually put into these categories and result in these types of journal entries. Why are we doing them? Because we're getting ready to do a financial statement, and it's at this point we want to make sure all of our revenue is recorded and all of our expenses are recorded. If they aren't, it's not going to give us a true financial picture. Now, we are not going to do an accounting worksheet. Your author loves accounting worksheets. These are very old school, and I don't focus on them. Instead, what we do is we take each of those journal entries. I'm going to kind of skip through. We take each of our journal entries and post them to our existing general ledger. So your general ledger at the beginning of chapter 3 is really from the end of chapter 2. Throughout the year, you were doing journal entries, posting them to the general ledger, and you've got a balance in an account. Adjusting entries will be posted to the same accounts that you used before, and you will update the balance in each of those accounts, whether it be the balance account or the T account. And you saw us doing that through these journal entries. So we don't bypass the general ledger with a journal entry. Remember, that's the center of our accounting system. It must be updated if we make any type of journal entry. Now, what results is an adjusted trial balance. Ouch. That is small, huh? Once we update our T accounts in the general ledger for any adjusting journal entry, we then find new balance in any account that has changed, increased or decreased because of the adjusting journal entry. And then we create a new trial balance with all the accounts and their balances. Now, some balances won't change, but some will. And it's those, we want to make sure we list every single account in our general ledger with its balance, whatever it may be. And then we add up our debit column, add up our credit column. So over here on the left is our adjusted trial balance. It's this trial balance that is used to create financial statements because all the revenues and expenses are on there. All the assets and liabilities are at their proper balance. So we make an income statement just like we did before. You can see the revenues are listed and the expenses, but you're going to see we have more expenses than we ever did. We never had depreciation expense equipment. Now we do. Insurance expense. Supplies expense. We had a supplies account, but we didn't have supplies expense. So you're going to see this expense section is expanding. Still an expense. Group them together, add them up, subtract your expenses from your revenue. If it's positive, net income. Then our statement of owner's equity. Still do it the same way. In this case, the company started at the beginning of December. They had owner investments of $30,000, net income of $37.85, withdrawals of $200, leaving them with a capital balance of $33,585. Balance sheet. Still prepare it the same way. We got a little extra things here and there. Cash, accounts, just transfer this information right from the trial balance. Where it's different is, remember, with our equipment. Our equipment now has a contra account attached to it. So any balance in that, which is going to be a credit, must be subtracted from our equipment cost. And we get our book value. It's that amount that's added to the other assets to get total assets. Liabilities, remember, unearned revenue is a liability. It's a liability. So we add it with all the other liabilities and come up with the total. And capital is still transferred from the statement of owner's equity. Add your liabilities to your equity. Assets equal liabilities plus equity. So Those are the next phases of our accounting cycle. When we're getting ready to do a financial statement, we make sure we do an unadjusted trial balance to prove debits equal credits. Then we search for missing revenues and expenses and create more journal entries to record those missing items. These are given the title adjusting entries. These entries are also posted to the same general ledger T accounts we already have in place, that same book, and we update their balances, and we call those adjusted balances for the time period. That leads us to creating our adjusted trial balance, and this is the trial balance we use to create our financial statements. We're going to bypass profit margin and its use in analyzing company performance. You're not responsible for that. You could read through it, and we're bypassing the appendix. So there also are some alternative ways of recording information in our accounting system. You're more than welcome to read through them, but you're not responsible for them. So this ends our discussion of Chapter 3, Adjusting Entries. Please ask any and all questions you may have on them.